Hi, thanks for joining me today. Welcome back, or if you're new here, hi, I'm Antonia. I run Abacus Jack with my business partner Andy, and our mission is to help small business owners get confident by increasing their financial knowledge of their business and break down barriers so you feel comfortable using the tools to manage your business and achieve financial wellness. Whether you're an experienced business owner or a starter or just considering starting a business, we want to help you understand the stuff they never taught you but assume that you knew. In this video, I'm excited to show you what corporation tax is, how to reduce it legally, and what you need to know in simple terms. If you're interested in more business basics videos and content to help you run your small business with more confidence, don't forget to subscribe to our channel. I also post daily content on Instagram so you can see what we get up to and some quick tips. Okay, so what exactly is corporation tax? It's a tax on profits made by limited companies in the UK and some clubs and associations. Profits are the difference between the money received and the expenses suffered during the financial year to come to a net profit. Some adjustments are then made to add back some expenses which aren't allowable for tax relief, such as business entertainment. And once these are added back, then you come to a taxable profit. And that's what corporation tax percentages are then applied to. Unlike income tax, which individuals pay, businesses pay corporation tax on their taxable profits, meaning total revenue minus allowable expenses. It's managed by HMRC, which is Her Majesty's Revenue and Customs, and companies must calculate and report and pay it themselves. There are no automatic deductions like pay as you earn. The tax is calculated for the company financial year, which is different to the April to April year, which individuals have. For example, if you started your company on the 10th of June, then you might have chosen an end date of the 30th of June. So that would be your financial year end. So if your financial year end is the 30th of June, then your most recent financial year for your company would be the 1st of July 2023 to the 30th of June 2024. If it's your first year of trading, then it'll be a little bit different. This is because HMRC can only handle returns of up to 365 days. If your accounting period is longer than that because you started midway through the month, then your actual first set of returns will be 2 corporation tax returns and 1 set of accounts. Using our earlier example, if you created your company on the 10th of June, when you get to the year after and it's time to prepare all of your reports, then your first corporation tax will run from the 10th of June for 365 days. Then you'll have a second return which runs between the 10th of June and the 30th of June to get to your financial year end. But you'll only have 1 set of accounts which runs from the 10th of June to the 30th of June the next year. You would prepare both returns at the same time, but you'd have to pay the corporation tax on the end using the end date of the first return. So normally if your year end was the 30th of June, your corporation tax would be payable 9 months and 1 day after that, which is the 1st of April the next year. However, if it's your first year, the first set of corporation tax is going to be due by the 11th of March. So watch out for that. So not every business pays corporation tax. So let's clarify who does. If you're a limited company based in the UK, then you're required to pay corporation tax on your profits. If it's an overseas company and it's a branch of that overseas company in the UK, then the UK division is required to pay corporation tax on their profits. And for some non-profit organisations, if they have some specific trading activities, then they may be required to pay corporation tax on the profits made from those trades. If you're a sole trader, you don't have to pay corporation tax. Instead, you pay income tax and national insurance deductions, which you report through self-assessment, which is a different system. So how much is corporation tax? The rate varies between 19 and 25%, depending on your profits through the year. There's a small profits rate at 19% if your profits are less than £50,000. The top rate of 25% is for profits which are over £250,000. If you're in between those two, then you get this thing called marginal relief, which means you get a blend between the two rates. Marginal relief allows companies to gradually increase the tax that they're paying as they increase their profits. For example, if your profits were £100,000 for the year, then your tax rate would be 22.75%. If you have more than one company, so if you're a director of company A and company B, then that will affect the corporation tax rate that you can receive for both companies. Effectively, the marginal rate is divided between however many companies that you've got, meaning that there's a risk that you could end up paying higher rates in all of your companies, but caused by the fact that you have more than one. This is because of associated company rules. Now let's talk about losses. So when would a loss happen? So let's think about if you're a startup and in that first year as a director, you have to put some money into the bank. The sales aren't that great. You have to buy a lot of equipment to get going. So when it comes to the end of the financial year, you haven't made a profit. That's then called a loss, and that carries forward into the next year. Then next year, let's say you made a £10,000 loss last year, but you've made an £11,000 profit this year. What you can do is carry forward the loss from last year into this year to save you some tax. So we can write off £10,000 of that £11,000 profit so that you only have to pay tax on £1,000. Alternatively, if you're an existing business and you have a bad year, then you can either use the loss against last year's profit, so you submit an amendment for your CT600 and you can reclaim the tax, or you can use it against next year's profits and future years until that loss is fully utilised. Unlike pay-as-you-earn, where deductions are automatically calculated and reported, businesses must handle corporation tax on their own. Some best practice tips for paying your corporation tax would be: 1. Keep your UTR letter when you get it. Normally this is when you incorporate the company and HMRC registers you for corporation tax. It'll come in the post and it'll be a long reference number. This is your company tax number. Don't lose it. Keep a record of it, take a photo of it, put it in your bookkeeping system. 2. You need to keep accurate financial records. Using a system like FreeAgent or Xero is perfect for this. 3. File your CT600 on time. Your CT600 is your company tax return, which declares the profits and the corporation tax that is due. This is separate to the company accounts that you have to file to Companies House. It needs to be filed even if you made a loss or no profits. It has to be filed every year. Pay your corporation tax on time. It's due 9 months and 1 day after the year end, and if you're using the bookkeeping system, that'll tell you when it's due on your tax timeline. If you pay late, HMRC will slap a penalty on your account and then start charging you interest as well. So be on time. But before we get to a big bill, let's talk about things that you can do to reduce it legally. So claim the business expenses that are allowable. You can deduct costs like rent, wages, equipment, advertising. Use the annual investment allowance, which is available to you. This allows you to deduct the cost of things like vehicles and equipment. So say you have an office refit and you've bought some chairs and a table, and then someone joined the team and they needed a new laptop. Then you can put all that through using AIA, which is the annual investment allowance, and then that comes off your taxable profits to reduce them down. If your company invests in research and development, you might qualify for R&D credits. You can ask an accountant to support you with an R&D claim, and then that can reduce the corporation tax that you've calculated and also be applied to previous years to get a refund or change the profit into a loss that you can then carry forward against future profits. Make company pension contributions for the directors because they are tax deductible, so they will reduce the corporation tax. And use the loss relief that's available to you. If you're in a group, you might be able to share loss relief between the different companies. So always keep an eye on that. Making sure that you take advantage of these can save you thousands of pounds. Thank you so much for joining me today. I've loved being able to share with you some education around how corporation tax works for companies. Today we've covered what it is, how to reduce it, and when to pay it. All limited companies must pay corporation tax. The rates range from 19 to 25%, and there are tons of legal ways to reduce your bill. If this video was helpful, please give it a thumbs up and subscribe for more business tips to help you run your business. If you know anyone that you think this video might help, then please share it with them. If you'd like to apply these tips to your business or discuss becoming a client, then check out the links in the description below to book a meeting or connect with me directly. And don't forget to follow me on Instagram or Facebook for more daily tips. Thanks again for watching. See you next time.